Good morning, students. Welcome back to the session on Ind AS. So we'll now continue with our discussion on business combinations. We'll do a quick recap about certain things in relation to business combinations we discussed yesterday. To start with, when we talk about business combination, there were two things which we considered as necessity, or we can say the mandatory things for business combination to happen. One was control. So whenever we acquire any business, till the time control is not there, we will not say it's a business combination. And second was about business. So whenever any business is acquired, only then business combination standard will apply. And that's why these two things become mandatory. As around control, we didn't get into too much details. We understood that control is the criteria which has been discussed in detail in Ind AS 110. We will also cover it in more detail when we'll start Ind AS 110 on consolidated financial statements. The other point was around business. Business involved three things: input, process, and output. And all the three things are mandatory for a business to be called as business, wherein at times it may happen that the output may or may not exist, but the input and processes are mandatory. Yeah, so these were two things on the basis of which we can say that whether business combination will apply or not. Once the business combination is there, then we started with the acquisition method of accounting. And for the acquisition method of accounting, again, few basic requirements are required to be established. One was about the acquirer, to understand who will be the acquirer, because acquirer is going to do this business combination accounting, because it's not the acquiree, only the acquirer will do the business combination accounting. So that's why it was important to identify the acquirer, and acquirer is the one who gets control over the acquiree, or who gets control over the business which is getting acquired. And this control has to be established as per the requirements of Ind AS. Yeah, just give me 1 minute. Second thing that we discussed was about the acquisition date. Now, this is again very important. Very important for two reasons. One, its understanding means its assessment is at times challenging. This may require a lot of assessment. Secondly, this date is very crucial because business combination accounting is required to be done on this date. On the date of business combination, this accounting will be required. Yeah. After this, we discussed about purchase consideration. Now, this is again very commonly known to all of us, that purchase consideration is something which will flow. It's an amount which will move from the acquirer to the acquiree. Acquirer will pay something to the acquiree in return for the business, and that is called as purchase consideration. Now, this purchase consideration could either be upfront or this could be deferred. Deferred means this is paid after some time. And at times this purchase consideration also involves some contingency factor, means on the basis of certain future event, this consideration may be paid in addition to the upfront consideration which has been paid, or in addition to the deferred consideration which has been paid. And that is called as contingent consideration. When business combination accounting is done, or we can say whenever acquisition method of accounting is followed, at that point of time, purchase consideration is required to be computed, which will include all the three aspects. Upfront consideration means paid upfront, deferred, including the contingent consideration, and all at fair values. Yeah. And we also discussed that this contingent consideration may take either of the forms, means from the issuer's perspective. Now, who will be the issuer in this case? Acquirer will be the issuer in this case. From the issuer's perspective, this may take either the form of equity or the form of financial liability, depending on the terms of the arrangement which are involved. All right. Yeah. Now, before I now get into the discussion related to contingent consideration, I'll just quickly explain you what is going to be that business combination account. Yeah. So we can just understand very briefly about this business combination accounting, wherein all of these ingredients are required to be used, because that will give you an insight about why we are looking into all of these details and what will be the final objective which is required to be achieved by determining all of these amounts. For the purposes of business combination accounting, a working is required to be done, or you can say a computation is required to be done, wherein we compute either the goodwill or the capital reserve. Do you all understand how goodwill is computed? Can you share some insights about the computation of goodwill? Means how do we determine goodwill? And it's not about the method, it's about the basis. When do we say that goodwill will arise, or how do we say goodwill arises? Quickly, if you want to share any thoughts about this goodwill determination, I am not talking about the methods of valuation of goodwill. I'm talking about how do we get goodwill in terms of its computation. Yes, if you have any thoughts on this, please let me know about goodwill. Yes, quickly, yeah. Well, there's something very, very common, and I'm sure you would have dealt with this. It's just that if you have some insights about it, it will be good to understand before I begin my discussion around this. Yes, quickly, yeah. Any thoughts, any inputs from your side on the goodwill? Okay, Ambika is saying, so when purchase consideration is greater than net assets value, Kaustav is saying purchase consideration is higher than net assets taken. Yes, that's correct. So let's understand about this. So we will put down first of all purchase consideration. And this purchase consideration will include all those three components which we discussed. Correct? Now from this purchase consideration, we will reduce assets and liabilities. And we will reduce assets and liabilities means we will take the net of these two. So I should say net assets and liabilities. Because if there are liabilities, that should ideally be added if we reduce that, correct? So we will compute a net number. Let's suppose assets are 500, liabilities are 200, so net amount will become 300. And these assets and liabilities will be of the acquiring. So this will be of the acquiring. These will not be of the acquirer. This purchase consideration is paid by the acquirer. Correct? Yeah. So let's suppose this is 1000 and let's suppose this is 700. So what do we get? 300. Now in this case, purchase consideration is in excess of net assets taken over. So what do we get? We get goodwill. We get goodwill. Pujita is giving the same answer and same is the response from Divakar. Very good. Now in this case, some important aspects for us. One, this has to be at fair value. So what does Ind AS 103 require? Ind AS 103 says that it has to be at fair value. Then Ind AS 103 says that these net assets which we have been talking about these should also be at fair value. So I'm just putting this in small form, net assets. So it says these should also be at fair value. Okay, yeah, both of them are required to be at fair value. Then we get the value of goodwill. And this is just a broad discussion I've done with you, something that you already know. Under Indian GAAP or under the practices which you would have seen other than Ind AS or IFRS, you would have seen that we don't compute the fair values of net assets. We don't compute the fair value of purchase consideration. But here, under Ind AS, we will be required to get their fair values first of all, and then we compute the goodwill. Okay, yeah, that's the difference. So first of all, what we have been doing is we have been trying to compute all of these amounts individually. We have been trying to compute all of these amounts individually. Yeah, clear? Okay. Then there may also be a situation wherein we may have 1,000 as the amount of purchase consideration and net assets taken over are 1,300. Means net assets taken over are higher than purchase consideration. Again, it's the fair value. Again, it's the fair value. So this is situation number A. This is situation number B. Now, if we have situation number B, we are getting negative 300. So do we say that we have a negative goodwill? The answer is yes. It's a situation of negative goodwill. But negative goodwill under Ind AS is required to be presented as positive capital reserve. So instead of goodwill, this will become capital reserve. All right. And once again, I'm not getting into too much details around it because we are required to cover this in more detail as we move forward. Idea was just to give you a perspective that what is it that we will try to, what is it that we have been trying to do in terms of acquisition method of accounting. Means what is this acquisition method of accounting? This method of accounting is nothing but the acquisition method of accounting. And this computation which we have done is very commonly called as PPA. PPA means purchase price allocation. Yeah, this is very commonly called as purchase price allocation. Okay, yeah. So this is something which you need to understand. Just give me 1 minute. Just give me 1 minute. Yeah. So now all through till the time we don't reach this purchase price allocation, what is it that we will do? We will now find out the ingredients which will be used in this purchase price allocation method. Now, these two things are common. Purchase consideration you would be knowing. Net assets you would be knowing. So you may be thinking, but sir, this is something which is commonly done. We know this. So how is it different under Ind AS? Under Ind AS, we will not really be limited to these two items. Other than that, many more my items are going to come, which we'll just discuss step by step. Okay, yeah. So for the time being, we will now discuss about purchase consideration. Okay, yeah. So what I'm doing is I'm now going back to purchase consideration. And in terms of purchase consideration, now we'll pick up some examples of contingent consideration that we started with. Okay, yeah. Now, purchase consideration, which will be about contingency, or we can say contingent consideration, is required to be fair value, and this has to be assessed whether this will become equity or financial liability. So now we can look at this example which is there in front of you, and I would suggest that all of you should attempt this example. First of all, on your own. On 1st of January 2007, A acquires 100% interest in B. Okay. A acquires 100% interest in B. So I'll also put down some facts, but you can read all of these facts from the screen, please. Consideration for acquisition is payable in following two tranches. Means the consideration will not be paid upfront. There are two tranches. One, immediate issuance of 1 million shares of entity A, that means acquirer, having face value of rupees 10 per share. Means first tranche of purchase consideration will be paid by the acquirer by issuing its 1 million shares, and each share has a face value of rupees 10. Number two, a further issuance of 0.2 million shares, means he will also issue 0.2 million shares after 1 year. If the profit before tax and interest for the first year after acquisition exceeds by rupees 5 lakh. Now, what do we call this second component as? We are not sure about it. Whether the business will earn this much profit or not, we can't say. But if this happens, acquirer will pay more consideration. That's why this second component will become contingent consideration. Correct? Clear? Okay. At the date of acquisition, fair value of shares of entity A is rupees 20 per share. So the face value of share of entity A was rupees 10, but its fair value is rupees 20. The management has estimated at the date of acquisition, fair value of contingent consideration is 2.5 million. Oh, very good. Now, this is something which is already given to you in the question, because we were worried that how do we compute the fair value of purchase consideration? How do we compute the fair value of contingent consideration? So this is something which is already made available to you in the question. Okay. At the end of year 1, means after 1 year, it is noted that entity A has actually met the condition. Which condition? That profit before interest and tax exceed rupees 5 lakh. Great. So now what will be required? Now, because this condition has been fulfilled, that's why entity A will also be required to issue more shares. Means it will have to actually pay this purchase consideration, which was contingent. At that date, means after the end of 1 year, fair value of shares of entity A is rupees 25. So now this fair value has increased further. Now the question arises around contingent consideration. So we can understand that contingent consideration is required to be recognized not at the time when this will be paid off, but it will start getting recognized from the date when the business combination accounting will be done. Correct? Yeah. That's why whenever we recognize it, first, what do we call it as? Initial recognition. And of course, its subsequent recognition, subsequent measurement will have to change or may change. That is something we'll have to assess. Yeah. So now we need to comment about both of them. We need to determine both of them. We need to determine both these amounts. All right. Yeah. So can you please get started on this? It's very simple. You need to just tell me what will be the amount at which contingent consideration will be initially recognized and the amount at which it will be subsequently recognized. So you can just let me know about these two things quickly before I begin with the solution. Quickly, if you can share these two things. Divakar is asking, sir, is the negative goodwill possible? As I told you, that whenever it becomes negative goodwill under Ind AS, it's called as capital reserve. Yes, any thoughts, any answers from your side? I'm waiting for your responses on contingent consideration. Initial recognition, subsequent measurement, both. If you can just share quickly. Huh? Okay. Nanda Usha has shared the response. She's saying initially it should be recognized at rupees 20 per share. Can you give me the exact amount, please? And what about subsequent measurement? Quickly. I think it's very simple for you to compute these two amounts. That's why I'm looking for your quick responses on this. Yes. Okay, great. Kaustav is saying at initial recognition, it should be recognized at rupees 20. If you can give me the full amount, that will be better. Chavi has given me the principle only. Chavi is saying at the time of initial recognition, measure at fair value. She has also given the amounts. Great. 22.5 million. Subsequently, it will be measured at fair value through P&L. And is there any reason why you are considering this to be fair value through P&L? Because if you are considering this to be fair value through P&L, that means you are calling it as financial liability. Am I correct in my understanding? Aparna is saying initially it should be 22.5 million and subsequently it should be 7.5 million. Okay. Divakar is saying 0.2 million rupees 20 per share. I think it's about initial. Ambika is saying 0.2 million into rupees 20 per share. That means 4 million INR is the initial recognition. Anjali is saying initially the contingent consideration will be 2.5 million. And Divakar has computed 24 billion. So I can see many of your responses for initial recognition are aligned, but mostly your responses around subsequent measurement seem to be different. Correct? Yeah. Okay, so let's go to the solution now. Okay, Aparna has changed the response on subsequent one. Aparna is saying subsequently it should be 2.5. Fine, no problem. So let's go to the solution. Now, in terms of the solution, one thing which you'll have to understand is about the assessment of contingent consideration. Okay, yeah. And if you'll go back to measurement and the classification of financial liabilities, you would remember how the financial liabilities were classified. If you go back to that principle, we discussed two buckets of financial liabilities. One was fair value through P&L, and the residual category was amortized cost, unlike in case of fixed financial assets. Remember? Yeah. And for the financial liabilities to be bucketed under fair value through P&L, we discussed that two items would be covered over there. One, financial liabilities which are held for trading. Other one, financial liabilities which are in the nature of contingent consideration at the time of business combinations. Remember? Yeah. So if we say that this contingent consideration will become financial liability, if we say that this contingent consideration will become financial liability, then where do we take it? We will have to take it to fair value through P&L. Means we can't take it to amortized cost. This will go to fair value through P&L only. Is that correct? Yeah, you remember this point? But before that, we need to determine whether this will be equity or financial liability. Because that's a question mark. Yeah. Okay, let's begin with the solution. At the time of acquisition, means on the date of acquisition, what do we need to compute? Purchase consideration, total purchase consideration. And what would that purchase consideration include? Purchase consideration would include two components. One, purchase consideration which will be paid upfront. And let's understand what is that. 1 million shares will be issued upfront at the rate 20 per share, because this happens to be the fair value. So how do we measure purchase consideration? At fair value. So 1 million shares issued at rupees 20 per share, what do we get? 20 million will be the amount of purchase consideration. So this will be the first component, 20 million. Correct? To this purchase consideration, which is paid upfront, we will also add fair value of contingent consideration at the time of initial recognition. So we are talking about initial recognition only. And when will that initial recognition happen? On the date of acquisition. Yeah. Now, on the date of acquisition, luckily, fair value of contingent consideration is given in the question itself. So what do? We'll just pick it up. It's an alignment problem currently on the presentation. So this becomes the second part of the purchase consideration. Sum of these two is what? 22.5 million. And what is this amount? This is the total of purchase consideration on the date of acquisition. Now, initially, at the time of initial recognition, at the time of business combination accounting, on the date of acquisition, what will be the total amount of purchase consideration? Therefore, 22.5 million. And out of this 22.5 million, 2.5 million pertains to contingent consideration. So that's why, how will the contingent consideration be recognized initially? We'll have to see. But at what amount? 2.5 million. It's given in the question itself. That's why I was just thinking that why you are taking a lot of time to answer this, because I asked you about fair value. I asked you about initial recognition amount to be considered in respect of contingent consideration only. If you remember my question, I asked you about contingent consideration only. Yes. Now, for the purposes of subsequent measurement, What does Ind AS 109 require? I told you, now we'll have to just assess the situation. Ind AS 109 requires that if you have to subsequently measure any instrument, you need to bucket that. First of all, you need to classify that instrument into equity or a financial liability. Now, because we are looking at this instrument, this contingent consideration is what? Equity shares, issue of equity shares to be done in future. Now, today, this issuance of equity shares, whether we should call it as equity or financial liability, now this determination will be done with the help of Ind AS 32. And once we determine that, its subsequent measurement will be done on the basis of their bucketing, which is available under Ind AS 109. Because only then we'll know as to how to measure it subsequently. Okay. So what do we now need to assess? Now we need to check whether it will become financial liability or equity. Now, one thing is very clear, that in this case, issuer will not pay cash. So when can an instrument become financial liability? When the issuer is required to pay cash. Correct? In this case, issuer is not required to pay cash. So that's why that criteria will not apply. For sure, there's no obligation to pay cash on the part of the issuer. So that's why we can say that this will become equity. But even when we say this will become equity, because cash is not required to be paid, there is another definition of equity as well as financial liability, which requires us to check that when the equity shares will be issued in future, is there any variability in terms of issuance of those equity shares? Remember, is there any variability in terms of issuance of equity shares? Means we need to check, are the number of shares fixed today, which will be issued in future? And is the amount also fixed today, which will be issued in the form of equity shares? Now, in this case, number of shares to be issued is fixed. Number of shares to be issued is fixed. And why do we say it's fixed? Because no variability is defined in the question. No variability is defined. Is there anywhere mentioned in the question that equity shares will be issued at the market price or at the fair value, which will be determined in future? No. No. So what do we assume? That the number of equity shares are fixed today. Amount is also fixed today. Yeah, because we know the amount. Therefore, in this situation, we will say that the criteria of fixed for fixed is met. And when the criteria for fixed to fixed is met, what will this instrument become? Equity and not a financial liability. And if this becomes equity, then we are not required to remeasure this instrument at the time of subsequent measurement. Correct? Subsequently, this will not be remeasured. Correct? So what will happen subsequently? Subsequently, this will continue to appear at cost. And what's the cost today? 2.5 million. So subsequently, this will be remeasured at the cost. And when we say remeasured at cost, means there's no remeasurement. There's no change in the measurement amount. Clear on this? So for this contingent consideration, at the time of subsequent measurement, no remeasurement is required. And when the equity shares will be issued actually, at that point of time, this equity will convert into equity share capital. Because what do we call this equity as? This equity is a different form of equity, which is called as other equity today. Because today we will call this 2.5 million as equity. But equity shares are not issued. So what do we call it as? This is called as other equity. And tomorrow in future, when actual shares will be issued by the issuer, then this other equity will take the form of equity share capital. Okay, clear on this? Yeah. Any questions, any doubts from your side on this? Please let me know. Yes, quickly. Any questions, any doubts in case you have on this? Please let me know. Any questions, any doubts in case you have on this? Yes, tell me quickly. Are you clear on contingent consideration? How this will be assessed? Because as I told you, in this illustration, we are not only discussing about the contingent consideration. We have also sort of integrated this with some principles of financial instruments. And that is something which you should expect in the examination also. Yeah, interlinkage of 2-3 standards or at least 2 standards. No questions? All right, so let's move forward then. So we have another example on contingent consideration. So let's discuss about this example. Ambika is saying, what if this is not paid? No problem. So whatever is appearing right now, that will get de-recognized. Okay. In the next example, the fact pattern which we have discussed in example number 6, that will remain same. Okay. With certain changes. Means all the facts. You remember example number 6, this one? Facts. Remember? Yeah? Okay. Now we are continuing with these facts. Except the following. Number of shares to be issued after 1 year is not fixed. Okay. In example number 6, it was fixed. Now it's not fixed. It's given in the question that number is not fixed. Rather, entity A, who is entity A? Acquirer, agreed to issue as many shares as have the fair value equal to 4 million after 1 year. If the profit before interest and tax for the first year following acquisition exceeds rupees 5 lakh. Okay, clear? Next, management has estimated that at the date of acquisition, fair value of contingent consideration is 2.5 million. This is same. This is not a change. At the end of 1 year, it is noted that entity has actually met this condition of profitability. So that's why contingent consideration will have to be paid. At that date, means at the date of acquisition, fair value of each share of entity A is rupees 25. So I think other than these two, everything else remains same. Yeah. Now in this case, the question is same. Once again, the question is same. Now, can you tell me what will be the amount of contingent consideration to be recognized initially and to be recognized, measured subsequently? Yes, over to you once again. Now, with the changes in these facts, can you give me your revised answers, please? Quickly, huh? Can you tell me what will be the answer now? Yes, I'm waiting for your response. Quickly, you can start sharing your responses now. Yes, in this example, how will your response change? Quickly, yeah? Okay, great. Divakar has answered. Divakar is saying, sir, initially it will continue to be recognized at 2.5 million. Subsequently, it will be recognized at 4 million. Okay, any more responses? Okay, Ambika has also answered. Ambika is saying initially it will remain same. Subsequently, I think she is answering. So should we go to the solution? Yeah. Should we go to the solution then? All right. So let's go to the solution. Now, initially, there's no change. So that's why initially my total consideration remains same. 20 million paid upfront and 2.5 million contingent consideration. Correct? So my total consideration at the time of acquisition remains same. Now the question arises that this contingent consideration, which we have recognized initially, what do we call this as? Should we call this as equity, which we considered in case of example number 6, or will it now change to financial liability with the changes in the facts? Because if that changes, then the measurement may change. And in this question, one thing is very clear, that in future, the number of shares which will be issued, those are not fixed. Number of shares to be issued in future are not fixed. So what does it mean? If the number of shares to be issued in future are not fixed, can we say that this may continue to be called as equity? Not at all. Not at all. Yeah. So what will it become? It will become financial liability. And I can see a lot of responses coming in. Anjali is saying that this will become financial liability. And Anjali has also shared the amount at which it will be recognized. Ambika has also determined what will be the classification of this financial liability. She is saying it should be fair value through P&L. And let's understand why. Now we all know that this is fair value, this is financial liability. And if this is financial liability, this is a contingent consideration at the time of business combination. So by default, where do we take it? Financial liability to be measured at fair value through P&L. So that means subsequently, this will have to be fair value, unlike in case of example number 6. Okay? Yeah. Chavi has also given the same response. Pujita is saying, so subsequently this will become 4 million and the changes in the fair valuation will go to P&L. Kaustav has also given a detailed answer which is same, and he has also shown the computations. Very good. Okay, now let's understand after 1 year, what do we do? After 1 year, this financial liability will be remeasured at 4 million. And why do we say 4 million? If we go back to the question itself specifies. Question says entity A agreed to issue as many shares as have the fair value equal to 4 million after 1 year. Means its fair value after 1 year should be 4 million. Yeah. So that means after 1 year, what's the fair value of this contingent consideration? 4 million. And what was the initially recognized amount? 2.5 million. So we'll have to increase the value of financial liability. If we increase the value of financial liability, what will happen? Expense will arise. And this will go to P&L. Correct? Clear on this? So the changes in fair valuation go to which head? P&L. This will go to P&L. 15 million. How do we get 15 million? 4 million minus 2.5 million. Now this is very, very important and I need your attention. I'm sure many of you would be knowing about it, but still it's very, very important because now you may have a lot of questions. Okay. So that's why I need your attention. Now, subsequently, after 1 year, we have contingent consideration, or you can say we have a financial liability appearing in the books at 4 million because we have updated this liability to 4 million. And now that event will also get triggered. In fact, that has triggered. Entity has achieved the profitability. So now this entity will be required to issue equity shares. So what does it mean? Now financial liability will have to get de-recognized, or you can say against this financial liability, equity shares will have to be issued. And you will be thinking, sir, does it mean that now this financial liability will be converted into equity? Yes, of course. Now this financial liability will de-recognize and equity will get recognized. And what is that equity? Equity share capital. This is not other equity. This is pure equity share capital. Why? Because each equity shares have been issued legally also. Okay. Now in this situation, what do? We will de-recognize 4 million and we will recognize equity. So when we de-recognize 4 million, what is the accounting entry will pass? What is the accounting entry will pass? Let's think about it. We will say financial liability at the time of subsequent measurement. This got increased by, this became 1.5 million. Okay. And the impact went to P&L. 1.5 million. With this, the total amount of financial liability became 4 million. Correct? Now, on the very same date, this financial liability will have to be converted into equity. So what do? We will have to say financial liability debited 4 million. And against this, what will happen? Equity share capital will be issued. This will be issued. Now, can we say that the value of equity share capital is 4 million? Let's understand that. Let's go back to that example. Now, in this case, what is the fair value per share? 25. So how many shares will be issued? 4 million divided by 25. How many shares will be issued? 1,60,000 shares will be issued. This is number of shares. Okay. But if you look at this 25, this is the fair value. And fair value means every share will be issued at this price. But can we take this entire 25 portion to equity share capital? No. Because equity share capital will be credited only with the face value. Equity share capital will be credited only with the face value. What is the face value? 1,60,000 into 10. So what do we get? 16 lakhs, or we can say 1.6 million. Okay. So what will be the differential amount? That is nothing but the security premium. That is nothing but the security premium. So what does it become? 2.4 million. So this goes to security premium. And the same treatment we will do. Same treatment means same set of accounting entries will arise in example number 6. The only difference is that in example number 6, instead of debiting financial liability, what do we debit? Other equity, and with a different amount. These two components will arise in case of example number 6 also. Why? Because in example number 6, the other equity amount is not appearing at face value. That is also appearing at rupees, what amount? You remember? 2.5 million. And what was that 2.5 million? That was once again fair value at the time of initial recognition. Okay, clear on this part? Divakar has also computed this number. Any questions, any doubts in case you have on this, please let me know, because I consider this to be an interesting as well as important part. Ambika is saying, yes sir, we have understood. It will be split into pure equity share capital and the premium amount, something which is very commonly done. The only thing is that in this case, at times we may get confused that why we are doing this split first of all, and if we are doing this split, why we are not taking entire amount to equity share capital, why we are taking some portion to securities premium. Yeah, so I'm hoping with this you are now clear. Okay, clear all of you? All right, so let's move further. So this was all about contingent consideration. Okay, yeah. Now, moving further, when this business combination will happen, at that point of time, it may happen that acquirer and acquiree had some pre-existing relationship. Means after the acquisition, these two parties will become one. Means they will either become part of same group, or they may become one entity only if the business is completely taken over. And in such a case, it may also happen that they are having certain assets and liabilities towards each other, means certain receivables and payables towards each other in relation to the transactions which they were doing prior to date of acquisition. Because on the date of acquisition, they will become one party or they may become part of one group. But prior to acquisition date, when they were executing these transactions, some of such transactions which would have resulted in assets for one party and liabilities for another party, what do we need to do? Those need to be knocked off. Those need to be settled. And how do we settle that? Let's understand. Say one party was selling certain goods to another party. So now it's a very simple case of receivable and payable. So what do? We knocked off. Because this contract will now be terminated if this party becomes if these two parties become a single party, correct? Similarly, if there is any other relationship between these two parties, we'll have to just settle all of those relationships with the execution of this contract. Execution of this contract means on the date of acquisition, all of these pre-existing relationships will come to an end. Clear? All of you? Simple, easy to understand. Now, we'll move on to the fourth step. That is about recognition of assets, liabilities, and we will also bring in a new concept which is called as non-controlling interest. What is this non-controlling interest? Under Indian GAAP, we used to call it as minority interest. So now we are bringing in all of these aspects. So the first thing that we discussed in relation to purchase price allocation today, we are now actually moving on to that accounting requirement. So let's understand about NCI briefly, and then we'll move on to all of these assets and liabilities. So there are two acquisitions which A would have done. A has acquired B Limited. 100% equity shares of B Limited have been acquired by A. And A has done another acquisition of C Limited, wherein A has acquired 90% shares. Can we say that both of them will become business combination? I am assuming that businesses exist in both the companies. So that's why business is there. And I am assuming that with 100% and 90%, A will get control of both the companies. So that's why both the criteria are fulfilled. So that's why both of them will become business combination. Now a question arises that in this case, when 100% shares have been acquired, what do we call this type of acquisition as? And this 90%, what do we call this type of acquisition as? See, in this case, when A has acquired 90% shares of C Limited, this is a partial acquisition. This part may be significant. This part may be major, but this is not full acquisition. Correct? That's why in this case, wherein full acquisition has happened, B Limited will become wholly owned subsidiary. Of A Limited. Why do we say wholly owned? Means 100% it is owned by A Limited or A. But C Limited is not wholly owned subsidiary. This will not be called as wholly owned subsidiary. C Limited will be called as subsidiary for sure, but it's not wholly owned. Why? Because it's owned by two parties. One party is of course A, there is another party, or there could be various other parties which may be holding remaining 10% in C Limited. Yeah. Now, in respect of this other 10% which is held by other parties in C Limited, this 10% portion, because this is a minor amount, and these shareholders don't have control. These shareholders don't have control over C Limited. That's why, what do we call it as? Non-controlling interest. Alright, clear? We call it as non-controlling interest holders, NCI holders, or in simple terms, we call this as NCI. Okay. Now, whenever we will do purchase price allocation, now we'll keep using this term purchase price allocation, NCI will also be required to be computed. So that means for the purposes of business combination accounting, other than those two items, purchase consideration and fair value of net assets, NCI will also be required. And we'll see as to how this will be required. How do we fit in NCI in terms of computation of goodwill or capital reserve? PPA simply means computing goodwill or capital reserve. So therein we will need NCI. Yeah. Hoping you have understood the meaning of NCI, correct? So let's now begin with the discussion around PPA. For PPA, assets and liabilities are required to be fair value. And how do we fair value them? It's very simple. Fair valuer, or you can say an expert fair valuer, will have to be engaged, or this can be in-house with the entity who will do the fair valuation of assets and liabilities, on the basis of which net assets at their fair value will start appearing at the time of PPA exercise. Correct? Yeah. And this is required to be done for all the items. This is required to be done for all the items. Okay. Now I have this very small example which we can discuss. On 1st of April 2017, PQR Limited merges with ABC Limited. Net assets of PQR include investments in two wholly owned subsidiaries, P Limited and Q Limited. So which entity is getting acquired? PQR. Who is the acquirer? ABC. The acquiring PQR had two assets in its balance sheet. Those two assets were investments in its subsidiaries. Means the acquirer had two subsidiaries, P and Q. On merger, means at the time of acquisition, how will these investments be accounted for in the separate financial statements of ABC Limited? Now, when ABC Limited will acquire PQR, so all the assets of PQR will come to ABC. All the liabilities of PQR will also come to ABC. Now the question is, how do we account for these two assets of PQR? Because we have this limited information about PQR, so that's why we are required to comment only about these two assets. Okay, we are not covering this entire piece over here. It's only a small piece. Okay. So let's get to the solution, please. But I think so the right part of the board is not visible. Okay, this part, yeah. So there's some problem over here. Correct. Let me just see. Right part of the board is not visible. Let me just adjust this now. So I'm hoping this is visible. Jay, if you're around. I'm hoping this will become better now. You can just let me know, is this visible? You may confirm this now, please. I'm hoping this should become visible now. Okay, going back to the discussion. At the time of business combination, what do? All the assets and liabilities will be measured at fair value. Now, on the basis of this principle, we'll have to consider all the items in the financial statements of the acquiree at fair value. Correct? Then the standard says, based on the above principle means considering the requirement to fair value each and every asset and liability of the acquiree, measurement should be done on the basis of their fair values at the time of acquisition. Okay. With certain limited exceptions. Now, what does it mean? That even though standard requires that all the assets and liabilities of the acquiree will be valued at fair value, still there are some exceptions. Means some assets and liabilities will not be measured at fair value. They will not be measured at fair value. There are some exceptions, and we'll discuss about those exceptions later. Then the standard further says, in the absence of any exception, means other than those exceptions, all the items have to be measured at fair value. In the absence of any exception for fair valuation of investment in subsidiaries, the same principle will apply. Therefore, the fair valuation will also be required for this particular type of asset. Means any investment of subsidiary, or you can say any investment of this acquiree in its subsidiary will also be fair value. Clear? Clear on this principle? Now, on this principle, I'll just first of all give you the background, because you may be thinking, sir, what is this point? Though we have understood that this is required to be fair valued, but what was the context? So we are talking about a situation wherein one company acquired another company. Let me just get on to those names. So what were the names of those companies? PQR and ABC, correct? So ABC acquired PQR, and PQR had two investments, P and Q, and this entire piece has been taken over by ABC. Yeah, P and Q were subsidiaries of PQR. As per Ind AS 109, if you remember, What are these two items termed as? Can you tell me? For PQR, now it's a question to all of you. For PQR, its investments into P and its investment in Q, what do we call it as? Quickly. See, all of your knowledge around financial instruments is getting tested. Yes or no? You may be thinking, sir, we are wondering, are we doing Ind AS 103 or we are going back to financial instruments? And this is interesting, huh? And this is the good part about it. Yes, quickly. What do we call these two investments as per Ind AS 109? What is the technical term you will attach to this? Quickly, can you give me the answer, please? So the board has become visible. Very good. Divakar is saying, sir, these will be called as assets. For calling an item as asset, do you go to Ind AS 109? So is there anywhere written in Ind AS 109 that you will call an item as asset or liability? No. Aparna is saying no, sir. Asset has to be there at the first instance. We will go to Ind AS 109 to check whether it will be financial asset or not. And Aparna and Kaustav are saying, sir, these two investments of PQR will be called as financial assets. Excellent. Excellent. Now, I will ask you one more question. How will you measure these two financial assets in the books of PQR? Quickly. See, these are very, very simple things which we have discussed. Quickly, how will you measure? Forget about this business combination for the time being. Ignore this business combination. I'm just saying for PQR, how will these two financial assets be measured? Subsequently as well as initially. Quickly, can you tell me how will these two items be measured as? Yes, waiting for a response. How do we measure these two items? Yes, tell me. How do we measure these two items? Yes, I'm waiting for the response. Quickly now. It is very, very simple. And I would suggest all of you should try to attempt these things. See, this is something you should expect in the examination. So if you really want to prepare for the exam, just try to now start establishing the linkages. Because the same thing examination will test. Your knowledge not only about one standard, but also about application of another standard. Kaustav is saying, sir, assuming the business model as hold to collect, it will be measured at cost. Excellent. What about others? What about others? Ambika is saying initially it will be at fair value. What about subsequent? Chavi is saying it will be measured at amortized cost. Sir. It's very simple. So I think Ambika is completing her response. Now, this is something which happens with time. We tend to forget the concepts. Like for example, one assumption has been made just now. Do we really need to make an assumption over here? Tell me. If we have to talk about PQR, do we need to make an assumption about its business model? Not at all. Investment of PQR is into what? Equity shares of P. Investment of PQR is into what? Equity shares of Q. So even if we say the business model of PQR is hold to collect, which is no doubt true, let's assume it's hold to collect. Even then, can it become amortized cost? No. Why? Because SPPI will fail. SPPI will fail. So can it become amortized cost? Not possible at all. This will become fair value through P&L. And there were some complications that because it's an investment in equity shares which is not held for trading, that's why this may also be designated at fair value through OCI. But I'm just ignoring this designation also for the time being. Yeah. Now, what was the answer? Answer was fair value through P&L. For this one as well as this one. Correct? Now, what is the context of our question? This is a principle about Ind AS 109 that we have discussed. Further, there are certain exemptions, not under financial instruments, but under Ind AS 101, under separate standards. What do they say? Those standards say that if a company has got investment in equity shares, and if those investments in equity shares are in either joint venture, subsidiary, or associate, please listen to this very carefully. Please listen to this very carefully, and you can just note down this point. If this investment in P and Q happens to be in subsidiary, JV, or associate, in our example, it was subsidiary. Let's suppose it was JV or associate. Then there is a choice available to the company, either to measure at fair value through P&L or at cost. It's not amortized cost, it's normal cost. Because you must be knowing now that amortized cost is different from normal cost. And you will be thinking, but sir, we didn't discuss about this in financial instruments. Yes, because financial instruments doesn't discuss about this principle. This comes from another standard and something which we can now use over here. Now clear? And you will be thinking, but sir, how do we know whether an investment will be in subsidiary, JV, or associate? This information will be there to you in the question itself. Okay, clear? Now the context of our question. Now let's go back to our question. Context of our question was that generally any company would keep its investment in its subsidiaries at cost. Generally, they will keep them at cost. Generally, they will not keep them at fair value through P&L. Generally, this is not a practice you'll see. You'll see practice of recording investments in subsidiaries, JVs, and associates at cost. Now, considering that this option was available, PQR would have recorded these investments in subsidiaries, this one and this one at cost. Now, when PQR moves to ABC, both these investments also move to ABC. Do we still have that option of keeping this at cost, or we will now have to change this to fair value? So therein we understood that at the time of business combination, there is no exception around these two assets. So if there is no exception, then these two assets will also have to be fair valued if not done earlier. If this entity would have chosen fair value, then it will remain same. But if this entity would have chosen cost earlier than the date of acquisition, then this will also be required to be fair value. Clear? I just gave you the background as to why this question has been asked. Otherwise, this may appear very, very simple to you. Correct? Clear on this now? Okay, now we will discuss something very interesting. And I am taking you back to PPA. On PPA, we discussed that we should have purchase consideration as 1000. Then we have net assets. Okay, all at fair value. So I'm not writing the fair values. Net assets. Net assets means assets less liabilities. And let's suppose this came out to 600. So what did we get? We got 400 as goodwill. Correct? This was goodwill, 400. Now there seems to be some gaps over here which we need to bridge. And now we are just bringing in all of those items. As I told you that this is not the only thing you'll see in PPA. There are many things which will come into PPA. Now let's see what all things are required to be incorporated in PPA one by one. A business has been taken over, which is clear over here, for which 1000 consideration has been paid. Let's suppose this is rupees in lakhs. And you may be thinking, sir, how can a business be acquired for only rupees 1000? So 1000 has been paid, against which assets worth of 600 have been acquired. And assets worth of 600 means these were all assets which were appearing in the books of acquiry. How will you pick up these assets? You will look at the books of acquiry, and any asset which will be appearing in the books of acquiry, we will fair value them. Correct? This is how we will do this. We will fair value them. Correct? Okay. At times it may happen that there are certain assets of the acquiry which may not appear in its books. And let's think about those assets. Goodwill. Do we recognize self-goodwill, self-generated goodwill? No. As per the standard on intangible assets, which I'm sure you would have covered, self-generated goodwill is not recognized. Yes or no? Now what has happened? This was the self-generated goodwill. This got recognized. Okay. In this PPA exercise, you would have noted that goodwill is a balancing figure. Goodwill is a balancing figure. Correct? And we understand that goodwill was not recognized by the acquiry earlier. So that's why now this goodwill will get recognized. There could be many other assets, or I should say intangible assets of acquiry, which may not have met the criteria of intangible assets earlier. For example, it may be about the brand. It may be about the brand. So if you look at the brand, will the brand have some valuation? Yes, of course. But the brand which is self-generated, will that get recognized as per Ind AS 38? No. That is not recognized as per Ind AS 38. An entity may have a signed long-term customer contract. An entity may have signed long-term customer contracts. Now, if an entity has signed 20 years terms, let's suppose if an entity has signed contracts which will go on for next 20 years, and now this entity is acquired with or say by another entity. So let me just put the names of the acquirer and acquiree. So let's suppose A has acquired B. Let's suppose B had signed 20 years contract, and for those contracts 17 years are still remaining. A has acquired B. So what will happen? Those signed contracts will also shift to A. Yes or no? The business will shift to A. So the signed contracts will also shift to A. Another example. Let's suppose B was operating in the industry, in the market for last 15 years, because of which B had established various customers, and some of the customers are loyal to B, means they will stay with B. Even if B is acquired by A, they will continue to stay with B. Now, whenever any valuation of business will be done, will that valuation of 1000 include value of those intangible assets or not? Assets like brand, assets like signed long-term customer contracts, asset like customers which are there with the company, or you can say associations with the customers. Will A pay some value for these things or not? Of course, yes, the valuation will include this component as well. So that means there are certain intangible assets which are appearing at nil. If you look at the books of acquiry, they are appearing at nil value. Yeah. And when B is getting acquired, nil value of those assets or those intangible assets is also getting acquired by A Limited. Yes or no? But A Limited is paying some price for that. When A Limited is paying 1000, 600 out of that 1000 is getting allocated to all of these assets and liabilities. But the portion of this 1000 which pertains to these intangible assets, is that getting allocated to those intangible assets? Not at all. That is not getting allocated. Where is it going? This is by default going to goodwill. Ideally, what should we do? We should bring in those intangible assets over here, put the fair valuation of those intangible assets against them, and then compute the goodwill. Let's see. Let's suppose if we say the fair valuation of those intangible assets is 100. So what will be the amount of goodwill? 300. So that means ideally the goodwill should be measured at 300. But if we don't recognize intangible assets, then what will be the value of goodwill? 400. So in a way, in such a case, what are we doing? We are subsuming the intangible assets with goodwill. So we are just subsuming those intangible assets with goodwill, which is not appropriate. We should bring out those intangible assets from this goodwill to a separate portion. That's why whenever PPA exercise will be carried out, or you can say at the date of acquisition, Ind AS 103 requires two things to be done. Ind AS 103 requires identification Ind AS 103 requires identification of any such intangible assets which are not recognized by the acquiree because they did not meet the criteria of intangible assets as per the standalone financial statements of acquiree, but which may now be recognized, and then recognize them. So those will be recognized for the purposes of business combination. And you may be thinking, but sir, we are accountants. To identify any asset or liability was never our role. Our role was always starting from recognition. Whenever the management will say that this is the item, we will recognize it, we'll measure it, because that's our role. We are chartered accountants. How can we be asked to identify? Yes. So this is something which comes additionally. We will have to identify, we will have to look for all of these intangible assets. We can't just assume that if these intangible assets are not given to us, then those do not exist. This exercise will also have to be carried out by the person who is doing this PPA exercise. Clear? So that's why I'm saying it's not limited to recognition. This before recognition will require identification by the management of the company. Okay, clear on this, all of you? Yeah. So this is another very important aspect of business combination accounting, which will require identification of intangible assets and their recognition at fair value, and because of which the goodwill amount will get corrected, will get adjusted, and now goodwill will be appearing at the correct amount, because earlier these intangible assets were mixed up with goodwill. So now those are not mixed up. Or you can just simply say that we are required to compute fair value of net assets. In a way, these net assets should also include any such intangible assets. Simple, easy to understand. Yeah. Any questions, any doubts? If in case you have on this, please let me know. Yes, quickly. I'm waiting for responses. Any questions, any doubts in case you have on this, please let me know. Yes, do you have any questions, any doubts? Quickly now. Yes, quickly. Any questions, any doubts? No? All right. So then what we can do is we can now take a break of 10 minutes. And after the break, we will discuss some examples of these type of intangible assets, because you may be thinking, sir, are we only limited to customer contracts? Are we only limited to brands? Or how do we identify them? So we'll discuss some examples. With the help of those examples, we'll understand how do we identify. Because their recognition and measurement is very simple. You have to just put down those values and recompute the goodwill. But how to identify or which all assets to consider, which all assets not to consider, means the intangible assets, is very important exercise at the time of PP. Okay, clear? Yeah. If you have any questions, you can just send your queries. Okay, great. See, same is the query from Anjali. Anjali is saying, sir, how do we identify intangible assets from goodwill? You will not be required to identify intangible assets from goodwill. You will have to identify intangible assets. And how do we do that? That's why I'm saying we'll discuss some examples. Pujita is clear. Rajshekhar is saying, sir, I have a doubt in cash flow statement that is about government grants classification. Okay, Divakar is clear on this. Yes. So Rajshekhar is saying, sir, whether we take it under investment or financial, that will depend on the purpose for which it is received. Okay, same basis you'll follow. Clear? Any more queries? In case you have, you can just send your queries. And before we start our discussion after the break, we'll just pick up your queries and then we'll move on to the discussion on these type of examples. All right. Jay? Hi, welcome back. So we can now continue with the discussion on intangible assets. So we can move on to example number 17, please, on page number 13.46. Yes, so look at this example now. Customer and subscriber lists are frequently licensed and they therefore meet the separability criteria. Now, what is it that we have been discussing? List of customers, list of subscribers of the acquiring. Now, whether they will meet the criteria of intangible assets or not. And if they meet the criteria of intangible asset, what do we consider? If they don't meet the criteria of intangible assets, they would not be appearing in the books of acquiring. Correct? Now, when we do the business combination accounting, at that point of time, we understand that these two are the intangible assets, or maybe a combined or combination of these two was an intangible asset. Now we'll have to recheck. We'll have to identify whether this intangible exists or not. If this exists, then once again we'll evaluate this. So we are doing that. So we are saying customer and subscriber lists are frequently licensed and therefore they meet the separability criteria. This is as per Ind AS 38, which requires separability criteria to be there only then you recognize intangible asset. Even if an acquiree believes its customer lists have characteristics different from other customer lists, the fact that customer lists are frequently licensed generally means that the acquired customer list meets the separability criteria. However, a customer list acquired in a business combination would not meet the separability criteria if the terms of confidentiality or other agreements prohibit an entity from selling, leasing, or otherwise exchanging information about its customers. Okay. Now the question was whether we can recognize customer list as intangible asset or not. See, before we recognize a customer list, as we discussed, the idea is also to identify. Now, a question will arise, sir, how do we identify all of these intangible assets? Means, how do we get to know about all of these intangible assets? So, for identification of all of these intangible assets, a discussion will have to be done with the management. An understanding of business will have to be obtained. An understanding of contracts of the company will have to be obtained, on the basis of which one will get to understand what all could be the possible intangible assets. And all the possible intangible assets will then be requiring the analysis like the one we have done in example number 17, and they will then be recorded in the financial statements at the time of business combination accounting. Okay, clear on this? Okay, so let's move on to one example, illustration number 17 now, on page 13.47. Illustration 17. Company A, FMCG company, acquires an online e-commerce company. Company A has acquired E. Company A has acquired online commerce, e-commerce company E, with the intention to start its retail business. Okay. The e-commerce company has over the period 10 million registered users. This company has got registered users. However, e-commerce company E does not have any intention to sell the customer list. So registered users are who? They are the customers of this company. But this company doesn't have any intention to sell the list of these customers to anybody else. Should this customer list be recognized as an intangible asset in a business combination? Now, when E will be acquired by A, one will get to know about this customer list or the registered users. A question will then arise, can they be recognized as an intangible asset? Because identification is done. And as I told you, for identification, you'll have to understand the business, understand the contracts, etc., on the basis of discussions with the management. Now, in this situation, what do? Customer database, this customer list, registered user, customer database, whatever name we assign to it, does not give rise to contractual or legal right. Accordingly, what do we need to check? We need to check whether it's separable or not, as per the criteria given under Ind AS 38, intangible assets. This database can be useful to other parties, other players in the market, and company E has the ability, if required, has the ability to transfer this list to any other user. Yeah. Accordingly, the intention not to transfer will not affect the assessment, whether to record this as an intangible asset or not. Hence, this database, this customer database or this customer list should be recognized as an intangible asset at the time of business combination at its fair value. Okay, clear on this? Now you may be thinking, sir, how can we record a customer list as an intangible asset? Because we have never seen such intangible asset. See, as we all understand that intangible asset is something which is not tangible in nature. And once again, what do we need to assess? We need to assess, first of all, whether it will become an asset or not. It will become an asset when there are certain future economic benefits which are associated with it. If there are future economic benefits associated with it, then it will meet the criteria of asset. Additionally, what do we need to check? Additionally, we need to check the separability, which Ind AS 38 requires, whether we have control over that asset or not, whether we can just sell out this asset, we can lease out this asset or not. If we can do that, then of course, this will meet the criteria of intangible asset and therefore it can be recognized at the time of business combination. Okay, clear? Clear on this? Yeah. So we can move on to some more examples. So I'll take you to the presentation now for more examples. Let me just see in case you have any questions. Kaustav is asking, sir, can we link contingent consideration with contingent settlement provision as per Ind AS 109 for the purposes of classification as equity or financial liability as per that provision? Not really. See, these two are different things. Even for contingent consideration, if you'll see, contingent settlement is one of the criteria which is assessed. Because what is contingent settlement? It means that for settlement, some contingency exists today. Contingency is something which is uncertain, not known to anybody. And something which is uncertain, its outcome is not known. Same thing exists for contingent consideration. So when you say can we link? So it's not about linking, it's one and the same thing. Okay. So moving further. So you can see on the screen, these are some of the examples. Technology based intangible assets could be there, contract based could be there, artistic related, marketing related, some of R&D related intangible assets could be there. All of those are required to be assessed. Let's look at this example now. Company P acquires Company S, a medical testing company, in a business combination on 31st December 2000X1. S provides testing services to patients, such as blood screening, based on referrals from their general practitioners. Who are those practitioners? Medical practitioners who provide primary care to patients. That means the doctors. S maintains a database with each patient's information. Database of the patient is available with S, wherein the name, address, telephone number, doctor's name, whom that patient consulted, insurer's name if the patient is insured, and the policy number. All of this information is maintained about the patients by company S, that is the acquirer. However, this patient information is protected by privacy laws, and S cannot sell, license, transfer, or otherwise exchange it. Okay. Now in this situation, there are a couple of questions which you need to answer. First, do you see any intangible asset over here? And can that be recognized at the time of business combination? Okay, yeah, quickly. Now it's up to you. Sorry, it's over to you. Yes, you need to answer this quickly. I'm waiting for a response. Yes, quickly. Can you answer this, please? Excuse me. Excuse me. Chavi is saying, so database is an intangible asset. And can you also tell me, Chavi, whether we need to recognize this or not? Both the questions you need to answer, please. What is an intangible asset? Or if there is any intangible asset, whether we will recognize that at the time of business combination or not. Quickly. Anjali is saying, sir, it's not an intangible asset. I think it is not specified. I am assuming that you have identified some intangible asset in this example. Yes, quickly, I'm waiting for responses. What is that? It Ambika is saying yes, there is intangible asset. What is that intangible asset? Can you please name that? And whether we can recognize that or not. Quickly, I think you are only talking about existence of an intangible asset, means which you identify and which you will then have to explore whether you can recognize that or not. But you have not been naming that. Can you give me the name of that intangible asset also? Okay. Webby is saying, so patient's information is intangible asset and this has to be recognized. All right. Divakar is saying patient information and this needs to be recorded at fair value. Kaustubh is saying patient information we cannot recognize because separability criteria is not met. Very good. Let's understand. In this case, the patient's information, or you can say the customer list, is definitely an intangible asset to be assessed. I'm not saying intangible asset is there, needs to be assessed. You can say a sort of potential intangible asset. Okay. But if you look at the restrictions, this information is protected by privacy laws, and because of which separability is not possible. Yeah. Whether or not P could recognize a separate intangible asset is dependent on this factor. If the separability is not there, then of course, customer list cannot be recognized as an intangible asset for sure. Yeah. So customer list goes out of the picture, means the patient's information goes out of the picture. Now there is another intangible asset. Let's understand about it. So one is the list of customers, list of patients. List of patients means database of patients. So that is one intangible asset. Another type of intangible asset which can be evaluated is about relationship with the patients, relationship with the general practitioner. Over a period of time, company S would have developed relationship with patients. Some of the patients would be coming only to company S. Some of the practitioners would be attached to company S, who would be providing business to company S. Will that not be an intangible asset? Yes. Because this relationship will continue even after acquisition by company P. Yes or no? So now this again will have to be assessed as intangible asset, whether they would meet the criteria of intangible asset or not, for which again information is not very is not very clear. So that's why we can't comment about it. But yes, this can also be one of the intangible assets which will have to be evaluated. Okay, clear? Next example, and I need your quick responses, please. Company P acquires company S. S is a bottling company on 31st of December 2000 X1. S has a 5-year agreement to supply bottles to the customers. S has a 5-year agreement to supply bottles to the customers. Do you see any intangible asset over here? If yes, can we recognize that? Aparna, I think, answered the last question. Okay, and Chavi was saying that it would not meet the separability criteria. Great. See, it's very important that you participate. It's very important that you share your responses, because even if it doesn't go correct, it's fine. But it's important that you start thinking about it, because in the examination, you'll have to do the same thing. Yes. Now, in this example, can you tell me if there is an intangible asset or not? Anjali is saying that this is an intangible asset, but what's the name of that intangible asset? Can you tell me? What's the name of that intangible asset? Yes. Quickly. What's the name of that intangible asset? Divakar is saying yes, sir. It can be recorded at fair value. And what is that it? Can you please name that? Because I didn't mention any name of intangible asset. So can you give me the name of intangible asset? Because you seem to be saying yes, its recognition is possible. Quickly. Vaibhavi is saying, sir, customer list is an intangible asset. Okay, I think you have answered for the previous question now. Because in this case, we don't have any customer list as such. What about others? Yeah. So let's go to the answer. In this case, if you will see, we are analyzing agreement, 5-year long-term contract. Correct? Now, this agreement, whether it's cancelable or not, this meets the contractual legal criteria. Additionally, because S establishes its relationship with customer through a contract, not only through agreement, but also over a period of time, a relationship is developed. Therefore, both this 5-year agreement to supply bottles to the customers and related customer relationships are two kinds of intangible assets, and both of them will be recognized. Correct? Yes or no? Yeah, because they will have some value. Okay, and I think same was the response from Anjali as well as Costa. Very good. So I think we can pick up this one also, and then we'll move further. Yeah. Company P acquires company S, a ski holiday company in a business combination on 30th June 2000 XX, which is during off season of S. S has a practice of establishing customer relationships through contracts, but it does not have any contract in place with the customers at the date of acquisition. Now, in this case, do you see any intangible asset, and can that be recognized? I think I received response of Pujita just now, and that was around the previous example. Huh? Okay. Yes. Yes, I'm waiting for a response. Try to answer this quickly. In this case, do you see any intangible asset or not? And can we recognize that or not? Anjali is saying customer relationship is an intangible asset. Okay, very good. What about others? What about others? Ambika is saying, in this case, in third one, means this one, there is no intangible asset as there is no contract which can be considered. All right. In this case, acquiring, that means S, does not have any contract. P does not recognize any customer contracts because those are not signed. However, relationship of S means customer relationship. Can that be an intangible asset or not? Yes. So that's why customer relationships will be recognized as intangible asset on the date of acquisition. Clear? All of you? Yeah. So what you should now note down, illustration number 18, I think. I would say illustration 18 and 20 you should note as your homework. Illustration 18 and 20. this is page number 13.49. Okay. So this is something which you should take up for your homework. Yeah. So we'll now move further. Now on the screen right now, you can see some exceptions. And these are the exceptions around the fair valuation. If we go back to our discussion on PPA, we discussed that each and every asset and liability of the acquiree at the time of acquisition will have to be measured at fair value with certain exceptions. Now we will discuss about these exceptions. Means what are these exceptions? And what do we mean by these exceptions? In very simple terms, I can say exceptions would mean that in relation to these items, fair valuation will not be required to be done. Okay. Now, why will that not be required to be done, or what will be required to be done is now something that we will discuss one by one. Okay. Yeah. So we'll now pick up each and every item in relation to the exceptions of recording assets and liabilities at fair value. Okay. Just give me 1 minute. So we also have some examples we'll pick from the study only. So I would suggest if you can go to page number 13.40. If you can go to page number 13.40 of the study material, please. So there's a table given on this page in relation to Ind AS 37, business combination, and contingent liability, etc. Can you see that table? Can you please go to that table? I'm not talking about the example. I'm just talking about the table which is given on that page. Yeah. Okay. Before that, I have a couple of questions from Kaustav and Anjali. Let me answer that. Kaustav is saying, but if there are no contract, how can we say it meets contractual criteria? Or we have to take into consideration the possibility. So it's not about the possibility. And it's not about the contract always. So we are not saying that only when we'll have the contract, it will become an intangible asset. Even when we have the relationship, which will continue, okay, which is sort of expected, that will have some value which the acquirer would pay in relation to the valuation of the business. That is something which we separate out as separate intangible asset. Okay. Anjali is saying, sir, I have one question that we have identified customer list and customer relationships as intangible assets, but how do we measure them? Because for an intangible asset, 3 conditions need to be fulfilled. Future economic benefit, cost can be measured reliably, of course. So one is about future economic benefit. We definitely see future economic benefits out of these assets. That's why we are recording them. Second point is their cost can be measured reliably. Now, what is going to be their cost? Fair value. Their fair valuation will have to be done. Now, I'll come to your question around how the fair valuation will be done. Third, you're saying is about separability. I think you have not mentioned that we have established. So that is separable. Now, as around the fair valuation, which seems to be a concern, that how do we fair value that? Now, again, I'll break this into 2 parts. For the purposes of your examination, you will not be required to do fair valuation. That fair value would be available to you, if at all required anywhere in the question. And in practical life, now let's move beyond examination. In practical life, how do you fair value that? So this will require fair valuation principles, fair valuation methodologies to be adopted, which can be done with the help of fair valuation experts. So there are valuers in the market who can do valuation around any of these type of instruments or any of these type of intangible assets or assets. Yeah, clear on this, how this will be done? Okay. Now, talking about the exceptions. Contingent liability is something which we all understand is not recognized in the books of accounts. Correct? What do we do with contingent liability? We only disclose that in the financial statements. That's been our understanding so far, and which has not changed. There is a standard Ind AS 37 which deals with the requirements related to contingent liability. Means what will become a contingent liability is defined therein. How do we consider contingent liability? At what amount we consider contingent liability? In what situation we consider contingent liability? It's all covered under Ind AS 37. That deals with contingent liabilities in detail. If you go to Ind AS 37, contingent liabilities have been defined of two types. Yeah. One wherein there is a possible obligation, one wherein there is a present obligation. Now that's why it's very important if you can just keep referring to this table on page number 13.40. And you will also require knowledge of Ind AS 37, which I am assuming you would have covered. In any case, if you have not covered, you can cover it later on and you can make a note around this. So Ind AS 37 talks about two types of situations which may result in contingent liability. One wherein the obligation is possible, one wherein the obligation is present. At the time of business combination, all the contingent liabilities are also required to be measured in terms of PPA exercise. Means when we will do this PPA, what do? We have this purchase consideration 1000 less net assets, let's suppose 600, net assets, intangible assets, let's suppose 100, and let's suppose we have contingent liabilities, say 100. Now these contingent liabilities are also required to be measured, unlike what we do as per Ind AS 37. And you may be thinking, sir, how can we recognize contingent liability? It's required to be done. At the time of business combination, it's required to be done. And if that will be required to be done, then ideally this should also be fair valued. Correct? If you are fair valuing all, then this should also be fair valued. But there is an exception here. There is an exception here. Now let's go through those exceptions on this table. It says if the contingent liability is the one, which is in the nature of possible obligation, then as per Ind AS 37, we don't recognize it. We only disclose it. As per business combination, Ind AS 103 will not recognize it. That will not be recognized. Forget about fair valuation. It will not be recognized. Okay. Next, present obligation. If the contingent liability is in the nature of present obligation. Present obligation, the one which is not probable. Not probable means something which is having less than 50% chances, because probable is something which is having more than 50% chances. Something which is not probable that an outflow of economic benefits will occur. Okay. Now, even this contingent liability or even this type of obligation is not recognized as per Ind AS 37. But as per business combination, as per Ind AS 103, this will be recognized. This will be recognized if it can be measured liably. Okay. Number 3 is again a present obligation for which it's probable that an outflow of economic benefits will occur, but it cannot be measured liably. And if it cannot be measured liably, then can we really recognize it? Not possible. So that's why it also cannot be, it will also not be recognized. So we can say that now this appears to be an exception. That means there could be some contingent liabilities which will not be recognized, and there will be some contingent liabilities which will be recognized. So what is it? It's a sort of exception. So that means Ind AS 103 is excluding some contingent liabilities from recognition principle. That's why you will see this as an exception to the recognition principle. It's not an exception to the measurement principle. On measurement, it's not giving any leeway. On measurement, it's saying measurement has to be at fair value. But some contingent liabilities are not getting recognized, so that's an exception which we need to consider. Okay, clear on this? We'll get more clarity around it once we go through some examples. So let's look at example number 15 on the same page. Let's look at this example now. I'm hoping you would have noted down the homework. Huh? Suit for damages worth rupees 10 million was filed on company B for alleged breach of certain provisions of the contract. Company B had disclosed the same as a contingent liability in its financial statements. So there's a suit for damages which has been filed, and B disclosed this as a contingent liability. And this was considered as a present obligation for which it was not probable that the amount would be payable. So the probability of payment of amount was not probable. It was less than 50%. That's why it was only disclosed. Company A acquired company B and determines the fair value of this type of contingent liability to be rupees 2 million. Now a question arises, should this be recognized at the time of PP or not? So let's go back to that table. Is this a present obligation or a possible obligation? This has been a present obligation. If this is a present obligation, it should be recognized, provided it's measurable. So if it's measurable, we recognize it. So what do? Company A would therefore recognize rupees 2 million in its financial statements as a part of acquisition accounting, even if it's not probable that the payment will be required to settle the obligation. So that means even the contingent liability will get recognized. Clear? Clear on this? Yeah? Okay. Okay. Let's go back to more exceptions now. In fact, I have some examples which you can just, look at later on. Indemnification asset. Now let's understand what do we mean by indemnification asset. See, whenever any business combination happens, there are various types of liabilities or there are certain problems in relation to the acquiring which may result in liability in the future period. Let's understand this. Let's suppose A is acquiring B. Okay. B has been in existence for the last 10 years. And this is the date of acquisition. This is the date of acquisition. Okay. Now going forward, whenever any liability on B will arise, so automatically A will get impacted. Yes or no? Because A is acquiring B. But it is also possible that some of the activities or some of the events of the past may also result in a liability. Some of the activities or some of the events of the past may also result in a liability in the future years. Means after the acquisition date. Now what will be done? Let's suppose when B is acquired by A and a liability arises, or maybe due to some tax returns etc. which is filed, a demand arises in relation to income tax. A demand arises, let's suppose, in relation to indirect tax on company B, which company B will be required to pay. Then who will suffer because of this? Who will get impacted because of this? Its impact will go to A and not to the previous owner, because now A is the owner of B. Correct? Therefore, to avoid any of these situations, A will thoroughly do the due diligence of B. A will do the due diligence of B on this date. Before acquiring B, A will do its due diligence thoroughly to make itself comfortable that no such possibility remains which may result in the future liability in relation to the past periods. But this is something which is in the nature which cannot be checked on a 100% basis. You never know, there could be some non-compliance. You never know, there could be some transactions which may not have been covered by A, which may not have been looked at by A in relation to B, and which may result in a future liability. What will be done regarding that? To cover this, generally we see an indemnification clause exists in the sale purchase agreement. So when A will buy the shares of B, the sellers of the shares will indemnify A that tomorrow if any such liability arises, then it will not be borne by A, it will be borne by previous shareholders. It's a very, very common clause which exists in the contracts, and because of which A has got a cover, and this cover is nothing but an asset to A. This cover is nothing but an asset to A. And what do we call it as? Indemnification asset. Okay. This is something which we call as indemnification asset. Now a question arises that, sir, for each and every situation we need to identify indemnification and indemnification asset. How do we identify? At one place we are saying we don't know about it. And when we don't know about it, how can we recognize it at the time of business combination? Correct? Yeah. See, in this situation, standard says that indemnification asset will always have some indemnified item. For example, at the date of acquisition itself, it may happen that a tax litigation has been going against B, which has been shown as contingent liability equivalent to 100 lakhs. Sorry, 100 lakhs. So it's a contingent liability. It's been shown as contingent liability. Now, in relation to this contingent liability, seller has assured the buyer that don't worry, no liability will arise in the future. It's only contingent which I have kept in the financial statements. Now, what is this surety which seller has given? That is called as indemnification. So, what is the indemnified item in this case? This is the indemnified item. And what will become the indemnification asset? That indemnity by the seller will become the indemnification asset. Now question arises, how do we recognize it? The standard says, if the indemnified item will be recognized, then indemnification asset will be recognized. If the indemnified item will be recognized at cost, then indemnification asset will also be recognized at cost. If the indemnified item will be recognized at fair value, indemnification asset will also be recognized at fair value. So that means indemnification asset will go hand in hand with the indemnified item, and which means that it will not go as per fair value always. Correct? So if it will not go as per the fair valuation always, what does it mean? Once again, there's a situation wherein an asset is either not getting recognized or not getting measured at fair value. So that again seems to be an exception to the principles of fair valuation at the time of PPA. Clear? Clear on this? Now what we can do is we can now pick up some examples. With the help of those examples, we will get more clarity around this principle. Okay. So we can look at these examples on page number 13.41. Example number 16. You can please move on to this example. Example number 16. Company A acquires B in a business combination. On 1st April 2000 X1. This acquisition happens on 1st April 2000 X1. Okay. B is being sued by one of its customers for breach of contract for rupees 250. Sellers of B provide an indemnification to A for reimbursement of any losses greater than rupees 100. So there is a suit which is going on for rupees 250 and indemnity against this is provided for rupees 100. Indemnity is provided for rupees 100. Correct? There are no collectibility issues around this indemnification. So tomorrow A doesn't see any collectibility issue, means this indemnity amount will be received by A. But it's limited to 100, it's not 250. At the date of acquisition, company A determined that there is present obligation and therefore fair value of contingent liability of 250 is recognized by A at the time of acquisition accounting. Now this suit was what? It was a contingent liability. and this was considered to be a present obligation. And this is something we have just discussed, that if the contingent liability is in the nature of present obligation and if that can be measured reliably, then it will appear, it will get recognized. Okay, so this gets recognized at 250. Okay, and what is this item? Indemnified item. Because against this item, indemnification asset will arise. In the acquisition accounting, A also recognizes an indemnification asset equivalent to what? Rupees 150. And how do we get rupees 150? 250 minus 100. And why we are reducing 100? Because that is something which is already covered. Something which is not covered, equivalent to 250 minus 100, will take the form of indemnification asset. Okay, clear on this? Yeah. Let's move on to illustration number 15 now. Illustration number 15. We'll discuss some examples to get clarity around these principles. ABC Limited acquired beverage company PQR from XYZ. ABC Limited acquired PQR. And who is selling PQR? XYZ. XYZ were the previous owners. So they are selling this to ABC. Yeah. So they are the sellers. This is the company getting sold, and these are the buyers. At the time of acquisition, PQR is the defendant in a court case whereby certain customers of PQR alleged that its products contain pesticides in excess of the permissible limit that have caused them health damage. So against PQR, suit has been going on. PQR Limited is being sued for damages of rupees 2 crore. XYZ Limited has indemnified, XYZ sellers are indemnifying ABC for the losses, if any, due to the case for amount up to 1 crore. So they are saying, against this case, we are indemnifying you for an amount up to 1 crore. The fair value of the contingent liability for the court case is 70 lakhs. So now this is the expected amount of damage. Means tomorrow, if this results in a liability, it will be 2 crore. But if we compute the fair value of this contingent liability, so this is a contingent liability. If we compute the fair value of this contingent liability, this comes out to 70 lakhs. And you may be thinking, sir, how will it become 70 lakhs from 2 crore? Because 2 crore is the amount which will be required to be paid. On the basis of probability factor, fair valuation or the valuation is done. And on the basis of probability factor, we can say that today its valuation is 70 lakhs. How should ABC acquirer account for the contingent liability? Means this one, and the indemnification asset, if any. What if the fair value of the liability is 1.2 crore instead of 70 lakhs? So situation A is its fair value is 70 lakhs. Situation B is its fair valuation is 1.2 crores. In both the situations, we need to comment about the accounting of contingent liability and also about the accounting of indemnification asset. So with these examples, with these illustrations, you will not only get the clarity around indemnification asset, you will also be understanding in greater detail about contingent liabilities. Correct? Yes or no? Yeah. And please remember one thing, that for indemnification asset, your clarity around contingent liabilities or the indemnified item has to be crystal clear. Because if you will not be clear about the accounting requirement of contingent liability, your accounting of indemnification asset will automatically go wrong, which you must have observed. Yes, yeah. Okay, so let's look at the solution around this. Let me just see if you have shared some responses. Okay, Kostab has a query before this. Kostab is saying that this is fine, but what if the indemnified item is not known? How the indemnification asset will be recognized, or the indemnified asset will not be recognized in such cases? See, indemnification asset can only be recognized if the indemnity is given, number one. And for the indemnity, some specific situation has to be there for consideration around asset. Because if we don't know about any future event which may or may not take place, and which is sort of general indemnity which we have received, then we don't go for this indemnification asset. This is specific to the indemnified item that is recognized on the date of acquisition. Okay. Chavi is saying that this is limited to 1 crore, therefore it should be 1 crore. Chavi has given the response. Very good. Any responses from your side, please, before we go to the solution? And I was hoping that you are not looking at the solution of the study material while answering this. Huh? That's very, very important. Correct? Yeah? Okay. Yes. All of you quickly tell me your response, please. Yes, quickly, your response, please. No? So let's go to the response then. Yeah. In the current scenario, ABC Limited measures identified liability. What is identified liability? Contingent liability at rupees 70 lakhs. I'm talking about scenario A. And also recognizes a corresponding indemnification asset of 70 lakhs. Because if the indemnified item is limited to 70 lakhs, then the indemnification asset will also be limited to 70 lakhs. The net impact on goodwill from recognition of contingent liability and the associated indemnification asset therefore is nil. However, in case of situation, in case B, where the fair value of contingent liability is 1.2 crore, the indemnification asset will be limited to rupees 1 crore only. Why? Because it's limited to 1 crore. Its upper limit is given as 1 crore. Clear? Yeah? So that's why it cannot go beyond 1 crore. Yeah? Clear on this? Okay, so let's move on to illustration number 16 also. I think we can pick up 16 also. ABC Limited pays ABC Limited pays 50 crores to acquire PQR from XYZ. So 50 crore is paid. PQR manufactured products containing fiberglass and has been named in 10 class actions concerning the effects of these fiberglasses. XYZ agrees to indemnify ABC for the adverse results of any court cases up to an amount of 10 crore. So XYZ is giving an indemnification. Up to 10 crore. Please understand it's up to 10 crore. The class actions have not specified amounts of damages, and past experiences suggest that claims may be up to rupees 1 crore each, but that they are often settled for small amounts. Okay, that's been the history. ABC Limited makes an assessment of the court cases and decides that due to the potential variance in outcomes, contingent liability cannot be measured reliably, and accordingly no amount is recognized in respect of court cases. Contingent liability is nil because it cannot be measured reliably. So that seems to be a present obligation, correct? So it's a present obligation which cannot be measured reliably. Hence, this has not been measured. This has not been recognized. How should indemnification asset be accounted for in this case? Over to you. Yes, quickly. Just share your thoughts on the basis of whatever we have discussed, and please don't look into the solution of study material, though it's very small. I'm sure you would have looked at it, but still try to think about it on your own. Forget what is the solution in the study material. Try to think about it on your own and then answer this. Quickly, I'm waiting for responses. See, if you talk about contingent liability, if you talk about indemnification asset, so these are couple of exceptions in business combination or in Ind AS 103, which are considered to be sort of typical. So that's why it's very important that you understand this properly, understand this conceptually. Otherwise, this typical will become very, very difficult as the time passes by. Okay, yeah. And that is why it's very important that you practice questions. You attempt all of these questions. All of you, waiting for your responses. Yes, any responses from your side? Quickly, yes, tell me. Waiting for a response. So we can go to the solution then. Yeah. In this case, no contingent liability is recognized. Means the indemnified item is not recognized. ABC therefore will also not recognize indemnification asset. Yeah, it will therefore not recognize indemnification asset. Clear on this? Yeah. Let's go back to our understanding. What did we discuss? Indemnification asset will be recognized and measured on the basis of indemnified item. In this example, indemnified item is not recognized, so that's why indemnification asset is also not recognized. And we are not saying that its fair value cannot be measured. Its fair value may or may not be measured, but we'll ignore that. We'll have to make it go in line with the indemnified item. Okay, all of you clear on this? Yeah. So we can now move on to some more exceptions. So this one we have discussed. So let me just go back to the exceptions. Yes. So exception which was only in relation to recognition was contingent liabilities we have discussed. Correct? And I'm hoping that you have understood that why this is only in relation to recognition. Okay. Then the other exceptions which were in relation to recognition and measurement both included indemnification asset that we have discussed. Then there are few more items. Let's understand about those items. So I will start with assets held for sale. Assets held for sale are required to be accounted for as per Ind AS 1045. So there is a separate standard which deals with its recognition and measurement. And this standard also says at what amount assets held for sale are required to be measured. Okay. The basis which this standard follows is fair value less cost to sell. Means if there will be any asset held for sale, then it will be measured at fair value reduced by cost to sell that asset. Under Ind AS 103, when we will have any assets held for sale, we will record them. It's not that we will not record them, but we will not measure them at fair value. We will measure them as per Ind AS 105. And if we look at Ind AS 105, Ind AS 105 is not considering the fair valuation. It is considering fair valuation reduced by cost to sell. That's why it's an exception to the measurement principle. Clear on this? Yeah. Similarly, if there are any share-based payment awards at the time of business combination, those are once again not required to be measured as per this standard. Those are required to be measured as per the requirements of Ind AS 102. That's why once again, what do we say? They become exceptions to the measurement principles. Similarly, if there are any employee benefits, those are not required to be recognized as per Ind AS, those are not required to be measured as per Ind AS 103. Those are required to be measured as per the requirements of Ind AS 19. Ind AS 19 is a standard on employee benefits. So Ind AS 103 says that if there will be any employee benefit, it will be measured using the principles of Ind AS 19 only. That's why once again this becomes an exception. Okay, yeah. There are two more exceptions: reacquired rights and income taxes. And these two are once again in relation to recognition and measurement. One only for measurement, other one is only for recognition and measurement both, which I don't think we'll be able to cover in a short span of time because we are left with very few minutes now. So I'm just parking these two exceptions to the next session. We'll cover these two exceptions and we'll of course continue with the remaining part of this standard in the next session. All right. Yeah. So with this, we can just conclude our discussion for the day and we can also move on to your queries now, if you have any, before we wind up our discussion. So any questions, any doubts, you can just let me know. Kaustubh has one query. Kaustubh is saying, since as per the assessment made by ABC, I think he's talking about these examples. Okay. Contingent liability cannot be measured. Therefore, corresponding indemnification asset will also not be recognized. Okay. All right. So I think Kaustubh answered this question. Very good. Very good. Any query if you have in relation to whatever we have discussed so far? I understand some of you are just now moving. Thanks to all of you. Thanks, Chavi. Thanks to all of you because you have been participating, which is very, very good. But I would I suggest all of you should practice more and more questions. There are a lot of questions which are available in the study material. Some of them are given to you as homework, and more of those homework questions will come later on. For the time being, we have not covered significant part of business combination, so that's why we have not included many questions for the homework that will come later on. That's why for the time being, it's very important that before we meet next, you revise the discussions that we have had in the 2 sessions so far. Yes, any questions from your side? No? So if you don't have any questions, we can just conclude our discussion over here. Yeah. Thanks to all of you once again for your time and for your wonderful participation. Thanks so much.